Hello and welcome to the SCI video series to support the Accounting Foundations course. My name is Eric Andrews, and in this video I'm going to walk you through the entire process of entering a transaction in the accounting system. We're going to start with a single transaction, place that transaction into a T account, enter it into the general journal, and finally post it to the ledger. So let's get started. I have here a basic transaction here that is similar to what we've been following in our examples. On June 1st, Adam Johnson invested $50,000 to start the business. So in this case, Adam is taking $50,000 out of his personal checking account and putting it into a business checking account. In order for us to understand this more clearly, we're going to see that we're going to first increase the balance of our cash account. This is done with a T account on the left-hand side, which is a debit entry. That is going to be the first thing that we record then in the journal, because that's the debit side. At the same time, we need to represent Adam's financial interest in the company. So we're going to enter $50,000 into the credit side of Adam Johnson's capital account. So let's see how this would look at a general journal entry. If cash is our first entry, because that is the debit entry, we're going to take that and enter it into the first line of the journal. We'll have the date of the transaction, the account, and then the amount that is being entered on the debit side. This is followed by the owner's capital entry, which is going to be a credit entry. Notice that we indent slightly to make it easy to visually see the difference between the two accounts. At the same time, we're going to enter $50,000 on the credit side of the journal. Finally, we're going to create a memo that lets us know what the transaction was about. Now, if we post this information to the to the ledger, we're going to look first at the ledger form. We have the cash account here in front of us, and cash in this case is account number 101. Now, in this particular transaction, this one from the first, here is where we're going to enter the information that affects that particular account. In this case, I've added a description, but generally descriptions are not necessary unless the transaction is abnormal. Here we have a debit entry of $50,000, and that's the deposit of cash into that account, and that is going to then give us a $50,000 debit balance. Now, let's look at another transaction and see how this account works when we take money out of the account. For our next transaction, Adam Johnson purchased 3 months worth of rent for $9,000, and he did that using check number 1001. So let's look at this in the T accounts. We have here cash and prepaid rent. Prepaid rent, remember, is an asset account because that money is owed to us, or the rent is owed to us, so we're going to have that of value to the company. So we increase the balance of prepaid rent by $9,000, and that is going to be our debit entry on the left side of the account. At the same time, we have to decrease the balance of our cash account with a credit entry on the right side of the T account. So let's see this in the general journal. We again have a date of June 1st, and since the debit entry is to prepaid rent, that's going to be our first entry in the journal. We're going to enter $9,000 for the debit side. At the same time, we're going to have a credit entry of cash, again indented so that we can see that they are both separate types of transactions. And then we have the cash on the credit side. And finally, a memo showing that this was 3 months worth of rent that was paid with check 1001. So let's look at the effect on the ledger itself. In this case, we have another transaction right below it, the first transaction, and this is going to be on that next line. I put a note in here that this was for rent so we would know what it is, but this time for cash account it was a credit entry. Now in this case what we're doing is we're actually decreasing the balance of our cash account. Cash, since it is an asset account, will always have a debit balance. So in this case, we're going to go through and reduce our balance from $50,000 down to $41,000. That shows the reduction of $9,000. This is something that is a little bit confusing for people at first, and I wanted to make sure it was very clear that when you have an account that has a normal debit balance, the balance is always going to be kept in the debit column. Even if you have a credit entry, you're still going to update your balance in the debit side. You'll never have an account where you have a balance on one side and information on the other. That's just a little thing to remember as you get started with this. That's an area I've seen some new accountants get confused with. So just make sure you're never going to have information on both sides of your balance columns. You may have information on both sides of your entry columns, but not on your balances. So I hope that clarifies a little bit about how this process works. In your exercises, you'll simply be working your way through more transactions, entering into the accounts, and carrying them all the way through to the ledger. Thanks for watching, and I'll see you in the next video.